really look at the camera.
Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Gregory Carpenter. Greg is the Managing Director for BTI Group Mergers and Acquisitions, or M&A. It's a business brokerage firm and located in Campbell, California. He's been a business sale intermediary since 1985, only yesterday, right? Anyway, the current focus of his business is on the middle market, valued from about $5 million to about $50 million. He was on the board of directors for the California Association of Business Brokers for 9 years. Greg is a frequent speaker about how to sell a business, and he is an arbitrator for the California State Bar and the Santa Clara County Bar Association. And Greg also says that he has a great home at Incline Village at Lake Tahoe that he doesn't get to use very much. And by the way, they rent it on the side, so if somebody's looking for a nice place to stay, there you go. Anyway, so today Greg and I are going to be talking about preparing to sell a business. We did another program about how to buy a business. Now we're going to talk about when you want to sell the business. And before I get started, I want to say this is just an introduction. It's intended to give you some initial information and hopefully be part of a continuing conversation with your own advisors. Okay, Greg, thanks for being here today and being a guest on the show.
I appreciate the opportunity.
Okay, what are some ways that buyers and sellers use to determine a value or sales price for a business?
There are lots of rules of thumb that industry people seem to know, like folklore. There are also books you can buy that quote rules of thumb, rough cut valuation methods, simplistic methods like some percentage of the annual sales or some multiple of the earnings. If you want to be a little more scientific about it, business brokers, bank underwriters, and accountants and business appraisers use a little bit more sophisticated methods where they recast the earnings, since if you look at almost any small business tax return, it doesn't show any profit, mysteriously. But that doesn't mean the business doesn't earn any money. So recasting just means figuring out where all the profit really went and adding it all up to see what kind of earning power the business has. We have comparable sale databases where you can look at dozens or even hundreds sometimes of similar business sales, the same sort of business, the same size, the same sort of earnings, and see what range of prices they brought to give yourself a pretty good idea of what the business might sell for. And then there's just the old-fashioned way of the seller said he wanted X, so I offered him blank percent of X.
Okay.
That's a good way to get stung.
Okay. So, what are some important assets and liabilities that typically aren't on a company's financial statements?
Well, the assets that you don't usually see are the intangibles like goodwill. And as far as assets that are important to the business that you don't see on the balance sheet, I'm not really sure. What would you say?
Well, one of them that I always say that people should be aware of that may be there and may not be there is just a customer list. So if a company is very well marketing oriented, then they have a group of customers that they should be in contact with regularly and that's being cultivated. And that is something that unfortunately in many local businesses isn't there, but it's something that you should find out if it is there. And it can make the difference as to whether this is a business that's really worth buying or not. Sure. And it's sort of involved in that goodwill number that you were talking about, but that's sort of what's behind the goodwill.
Sure.
The other thing is proprietary things like there's a proprietary technology, trade secrets, secret sauce.
Well, another way to say that is tribal knowledge.
Yeah.
Because a lot of these businesses have employees that have been there 5, 10, 20, even 30 years.
Yes.
They really know how to do their job really well, and a lot of it is not written down anywhere. And we call all that stuff tribal knowledge. So the collective knowledge of the employees that isn't written down anywhere, and the special skills they may have developed, and even the relationships they may have developed with vendors and customers, is all very valuable, and those are assets that you don't see on the balance sheet.
Okay, but so copyrights, patents, so those may or may not be there, but if they're there, they may showing a very small amount because it represents the investment that
the legal
company
cost
made.
it took to create
Yeah,
it.
to create it. But as far as what it represents, so it's a little bit like, you know, the Coca-Cola formula. Like I said, it's a trade secret. It's a key trade secret for that corporation. Excuse me. So, part of your due diligence is to find out what these things are. And you were talking about the tribal knowledge, if you will. Well, one of the first things that you'll want to do is to capture that, and also, okay, where does this knowledge lie, so that you can make the employment agreements and the other things to be sure that this isn't going to all just sort of leak off as soon as you acquire this.
That's right. You want to be sure you hire all the key employees.
What about some liabilities? So, we may have liabilities that we don't know about. Well, maybe there's a lawsuit that's pending that hasn't been included on the financial statements, depending on whether they have audited financial statements.
Or there could be discussions going on about a claim for damage of some sort that really hasn't been written down anywhere, that maybe the seller doesn't want to tell anybody about. That could be a contingent liability. It could be, too, that the seller may have done some really unconventional things with his prior year tax returns. And if the buyer buys the stock of that corporation, even though the seller gives him indemnities for any liabilities that arise from his period of ownership, the buyer's still going to have to deal with that tax audit because he owns the corporation.
Yeah.
And the seller may not even live in the country anymore. Who knows?
Yeah. Or the seller may not have sufficient assets to take care of the liability that may be there.
Sure.
So
there are a lot of things that don't show up that exist too, like gift coupons. A lot of times those are not put on a little business's balance sheets, but they may have thousands of dollars that they've collected and issued gift coupons, and people will walk in the store after the new owner takes over and present their gift coupons and want merchandise or service. And he's got to deliver. So he should be compensated by the seller for that, but if you don't know to ask about it and it isn't on the balance sheet, which it usually is not, then the buyer could get stung on that.
Yeah. So anyway, so there's a lot of these different things, and so this is part of, like, if you're on the buying side, you want to be aware of it as due diligence. And in a sense, if you want to protect yourself as a seller, really you should disclose.
The best protection for sellers is disclosure and disclosure and disclosure.
Right. Okay. All right. I'm thinking about retiring, and I'm thinking maybe in a few years I may be selling my business. Should I be operating this business differently when preparing to sell it? And if I should be, what are some things that I should be doing?
I think the answer is absolutely yes, you should. And as we discussed earlier, most businesses, after someone has owned them for a long time, are being operated for lifestyle rather than profitability or growth. So if you know you've got a few years before you're going to close the deal to sell your business, you'll add a lot of value by thinking about running it more for profitability and growth for the last few years than just for lifestyle. So all those things that you know you could do to make the business grow and be more profitable, but just haven't needed to because you're making plenty of money anyway, start doing those things. Something else too is really clean up your financial house. Get all your books and records in excellent condition. Maybe even consider getting audited financials, especially if your company is large enough that it might get purchased by a public company.
Yes.
Audited financials are critical. Another thing is, in small businesses, the owner pretty much has an organization that looks like a wagon wheel. He's at the hub, and there are spokes going out to each employee on the perimeter.
Right.
And he drives everything. Well, that makes it pretty tough to sell the business. It's better if you can organize, even if it's just a small one, a management team of key employees who manage critical functions in the business. Someone in charge of all your warehousing and materials handling and materials movement throughout whatever you're doing. Someone who's in charge of all marketing and advertising. Someone who's in charge of all the accounting, bookkeeping, human resources, and administrative, and so on and so forth. So for every functional department of your business, have someone who's accountable. You're going to find your life is going to be a whole lot easier. And yes, you have to make a little bit of investment in people to do that, but you're going to find that then it facilitates growth. Because suddenly you have time to do a little bit more business development than you did, because you're not doing all that stuff you used to do. Your management team's doing it now. That adds a tremendous amount of value to the business.
Right. And we talked about the tribal knowledge thing. So how do you, I would think that it would be helpful to, again, write this stuff down so that it's not just tribal knowledge, but now it becomes a business system. And basically you can put together a manual in front of your buyer and say, here's everything you know. This is how this business operates.
That's true. There are other benefits to doing that as well, and you'll find that you'll be able to control your expenses better. If everybody has to think through and write down everything they're doing, and then you all discuss it and analyze it, and you're going to look at some of these procedures and say, well, that's nuts. Why are we doing this? We're just wasting a lot of money here. Guess what? You're going to be making more money because you took the trouble to do that. Also, you might consider, if you haven't done it, if you're in a business where it's appropriate, become ISO 9000 certified. That requires you to do all this stuff you just said. Or if you're in a food-based or nutrition products or pharmaceutical kind of thing, really get on top of your GMP certifications and all your code requirements and documentation. And all these things will help you manage your business better and more profitably and make it more valuable.
Right. Okay. So what or who are good candidates for suitors to purchase a business? Who are the customers that you're looking for now to actually, now you're not looking to sell your product, you're looking to sell your business?
Varies according to the size of the business. In the smaller ones where individuals are the buyers, we call Main Street or mom and pop businesses. The best buyer for a seller who's going to pay the highest price and be most motivated to really make it succeed will be the first-time business buyer. A lot of times business owners think they probably ought to sell to their competitors, but what they find out is that the competitors view the value of the business as the cost of opening a new facility. And they really don't want to pay for goodwill. They want to pay for tangible assets. And by the way, they don't want to give you cash either. They want to pay you out of the profits once they take over and nothing up front if it's at all possible. Whereas an individual who's a first-time buyer is probably going to be able to pay you at least 90% cash if you have good books and records, if the sales trend in your business is flat or up, and if it shows enough cash flow on a recast basis to make the debt flow coverage, the debt service coverage for the SBA loan, and provide the minimum household requirement income for the buyer. So that way the seller can get paid 90% cash instead of maybe 30% and carrying a note for 2/3 and hoping the buyer succeeds.
Okay.
Now if you go to the middle market, of course, it's a whole different world. A little bit bigger businesses, the buyer is not probably going to be an individual. It's going to be either a private equity fund or a corporation. So it's a whole different matter there. The buyers are professional buyers. They expect a higher level of professionalism in the organization and systems and accounting records of the company. And they make quick decisions, and they're very picky about what they buy and don't buy. You may have to shop it to a whole lot more buyers in the middle market before you find the one that really fits your business.
Okay. Should I hire a business broker to help sell the business? What could I expect to pay for that service? And what are the benefits of using a business broker?
Well, my advice is that unless you personally know all the processes and procedures, including recasting of financials, business valuation, financing, all the legal aspects of the sale, and unless you also have time to do all the mind-numbing grunt work that's involved in marketing a business without seeing your own business slide downhill because you're not doing what you're supposed to do to run that, I think you ought to hire a business broker. There are many benefits. First of all, you should be able to spend virtually all of your time keeping your business healthy and growing and profitable. You don't want to take your eye off the ball there and suddenly realize, oh my gosh, my sales went down 30% last month because I was so tied up trying to sell the business that I forgot to do a few critical things to run it. So there's one big value add. The second is most business owners really don't understand recasting of financial statements, and they don't understand how to present the true earning power of the business and the true value of the business, whereas that's what brokers specialize in. Third, 7 out of 10 businesses that we sell happen like this. We have over 4,000 ads out there right now. We get over 2,000 buyer inquiries a week. The buyer's agenda when he calls is, oh, I'm going to get the broker to tell me everything about the business. Doesn't happen. We interview the buyer. We usually try to get him to come into the office unless he's very far away. If he's far away, we'll interview him over the phone. Once we understand his skill set, his mindset, his goals, and his resources, we will then show him businesses that match him, that he's probably qualified to buy and that will probably suit him and be interesting to him. Now, Mr. Seller out there, if he's trying to sell it all by himself, he can probably handle, what, maybe 6 or 8 calls from buyers a week. We get over 2,000.
That's a lot.
And out of that 2,000, the average time to sell is still 9 months.
Wow.
Think of all the buyers we have to weed through to find the right buyer for someone's business. Now, if you're seeing 5 buyers a week, and that would be a lot, you may never find the right buyer ever. So there's a big value add in that we're going to qualify buyers, we're going to sort through thousands of them, and we're going to find the one buyer who's going to be willing to pay the seller's price and mostly cash.
Okay. Now, if you are selling a business, what communication should be done for the employees?
Unfortunately, there's a lot of folklore that employees seem to have in common about business sales. And one of the erroneous concepts that almost is universally held is that employees fear when a new owner comes in, the new owner is going to fire everybody and replace all the employees with, quote, his own people. Nothing could be farther from the truth. Employees who've been on the job for a long time have a lot of specialized knowledge and skills about how to do their specific job. A new employee, without training and without that experience and knowledge, would be lost. The business might even fail if a new owner replaced everybody right away. Probably would fail. So it's very important for the new owner to keep the employees. But since nobody seems to understand that, then the normal way businesses are sold is by keeping the fact that the business is for sale highly confidential. All of the ads we put out are blind ads. You can't tell, even if you're an employee of that company, you can't read that ad and tell that it's your company. And even if you call in, again, we're not going to give out a lot of information over the phone. We're going to interview the person and find out all about them. And if we don't think they're qualified, we're not going to show them anything. And before they ever find out anything, they have to sign a confidentiality agreement, and where they promise to keep the information confidential and take accountability for damages if they breach that confidentiality promise and the business is harmed. So the employees don't usually find out it's for sale until just after the closing, when the seller is introducing the new owner, who then immediately tells everybody, hey, I'm looking forward to working with all of you. I'm hiring all of you on the same terms as your former employer, and I'd like to meet each and every one of you and get to know you and see how we can work together better to make this a better business. Then everybody goes, okay, I'm not going to get fired. Good, I'll keep doing my job.
Okay. What you were saying a little bit reminds me of a story that I read. It was in the book Patent, Ordeal, and Triumph, I think. And after World War II, General Patton was in charge of, I don't know, I think it was some little, either it was a city or a village in Germany. And he was highly criticized because basically he kept the same people working, doing the same jobs they were before. And of course, these were the enemy. And so why should they be permitted to keep their jobs? And he said, because they know how to do their jobs.
Good answer.
Okay. Okay, let's say I sell my business. Do I have a continuing exposure for the liabilities related to that business after I sell it?
You may have a contingent liability for any claim that arises due to something that happened during your term of ownership. But as far as all the liabilities from the point of close of escrow going forward, those are the liabilities of the buyer if he has agreed to assume those liabilities as part of the purchase price. All other liabilities generally must be paid off right out of the escrow funds.
Okay. So I guess one of the points, though, is that this is something really that should be in your contracts.
That's right.
As far as what your exposure may be, and if you don't, then you're leaving a big contingent liability right there in the open.
If you're using a broker, he's probably around here going to be using the forms created by the California Association of Business Brokers. Mm-hmm. And these are forms that have evolved over the last 25 years with a committee of 5 attorneys and 5 brokers that we meet once a month for a couple of hours and rehash everything and take everybody's input from all the brokers in the association, re-examine all the language in the documents and refine it. And they're highly refined documents, and they very thoroughly cover pretty much everything that needs to be addressed in a small business sale.
So again, that's another advantage of working with a broker, that he's already familiar with this stuff and so forth.
That's right.
Okay.
And I served on that committee for 14 years.
Okay, well, thank you. Well, we're glad we've got your wisdom is hidden in there. Okay, we're going to be running out of time before too long here. Got quite a few questions, but why don't I throw this out? Okay, we've talked about the business broker. Who are some of the other advisors that should be involved in this process?
Well, of course, the buyer should have an accountant who represents him, who can help him with his financial due diligence, and also tax structuring for allocation of the purchase price, where we split the purchase price up among the various asset categories that the business has, because that'll have future impact on the buyer's taxes. He should have an attorney who may conduct some background investigations on the seller and on the business.
Now we're selling a business in
this
case.
We're the seller. Okay. You should definitely have an attorney who's going to review your sale documents and who may conduct due diligence on the buyer.
Yes.
To make sure the buyer is not a scammer.
Okay.
Who is just trying to take over your business without really giving you much of anything and steal all the money and assets out of it and liquidate everything and leave town. Mm-hmm. So your attorney is somebody who really ought to check this guy out and make sure he's for real.
Yeah, or you may want to get a private investigator even. Possibly.
Totally, it's possible. And your accountant certainly should help you, the seller, with deal structuring to minimize your taxes due on the sale, or eliminate them altogether if it's possible. An estate planner would be a good person, and you should be involved with him quite a bit before the sale occurs, because to create some of the structures needed to manage your money, it may take some time. So you want to have all that prepared ahead of time.
Okay.
For example, if you're planning to use a charitable remainder trust so that there's no tax at all due on the sale, you need to have that set up several months before you even, in fact, before you even list the business for sale, and transfer ownership of the business to it. And that has some pluses and minuses, but the big one is there's no tax on the sale.
Okay. Can I or should I continue to work in the business after I sell it? And what are some alternatives?
Well, first of all, you want to make sure the buyer's going to succeed. Even if he pays you all cash, you need to make sure he's going to succeed. Because if he fails, guess who he's going to be pointing the finger at? He's going to say, you told me this business was netting X amount of dollars, and I've been running it for 6 months ago now, and it's not making anything. Well, of course not. He screwed it all up because he didn't know what he was doing. So you want to stay there long enough to make sure the buyer really knows how to run that business. Second, the buyer may have given you a note for part of the purchase price. You want to make sure he's able to pay that note. And third, if it has a lease for the premises, if we assigned several years of remaining lease term to the buyer, the seller is still contingently liable for that if the buyer doesn't pay. And depending on how the paperwork was drawn, the seller may or may not even have the right to take possession of the property and run the business again. So that's another point you need to make sure is handled in the sale in case the buyer does fail. Or maybe the buyer just, it unfortunately dies of some sudden illness or something, and the seller needs to come back in. You need to make sure you have the right to do that. And then sometimes in a sale, there's a payment that's contingent on future business performance. In other words, the business would be growing, the seller gets more money. To the extent the seller can facilitate that growth, it's in his interest to stay involved with the business. I've seen a seller stay involved as much as 4 years.
Wow.
And very happily so.
Okay. Well, we're getting down to the end here again, so really not time, I don't think, to do much related to more questions, but maybe what are some things that you think, if a person's thinking and getting in the mode of thinking of selling a business, some final words of wisdom?
Well, the big picture is make sure that you have all of your financial records in excellent auditable condition, and even maybe get them audited if your company's a little bigger. Disclose everything. The more you disclose in writing, signed and acknowledged by the buyer, the more protection you have that he can't come back at you later and say, gee, you never told me such and such. Disclosure, disclosure, disclosure. Build a management team if you have time. That adds value. Try to get a diversity in your customer base. Try to get as many different customers instead of a couple of big ones. And keep the business growing every year. It's impossible to get financed if you let it shrink. And try to distance yourself from the day-to-day management of the business as much as possible. It adds value when the employees are running it and you're just making sure they're on the job. You've created value. Okay,
Gregory, thanks again for being my guest today.
My pleasure.
Really appreciate it. As I said, folks, this is just an introduction to this, but we hope that we've given you some good food for thought, especially if you're getting into this mode. And this will be posted again on our website, financialinsiderweekly.com. So if you know somebody who's thinking of selling a business, this will be a great resource for them too. And we'll see you next time on Financial Insider Weekly.